Coming up on Market to Market. House lawmakers approve the Farm Bill, but only by removing nutrition assistance. A train carrying nearly 1 million gallons of crude oil derails in Canada, killing 50 people. And the Agriculture Department releases its latest estimates on supply and demand. Those stories and market analysis with Naomi Blohm next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, July 12 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Mirroring a long-standing trend in the U.S. population, the number of congressional lawmakers from rural areas has steadily declined since the 1930s. Realizing their weakening political clout, Agriculture Committee members included food stamps in the Farm Bill in the early 1970s in hopes of garnering urban support. The idea proved to be successful. Nutrition programs have remained in the legislation ever since, and despite being large and complex, farm bills typically are among the most bipartisan measures approved by Congress. But not this time. Federal spending on farm and nutrition programs has grown dramatically over the past 4 decades. The price tag for the program formerly known as food stamps alone more than doubled in the past 5 years, and fiscal hawks appear more interested in cutting federal spending than building coalitions. After the House defeated its own version of the Farm Bill in June, GOP leaders suggested splitting farm and nutritional programs into separate bills. Last week, however, a broad coalition of more than 500 groups, who would rarely agree on just about anything, urged House lawmakers not to separate the Farm Bill into 2 pieces of legislation. But that's exactly what House leaders did. And for the first time since 1973, the House of Representatives approved a version of the Farm Bill Thursday that did not include any nutritional programs.
The yeas are 216, the nays are 208. The bill is passed.
The U.S. House of Representatives passed a scaled-down version of the Farm Bill Thursday without including any provisions for food assistance. The 216 to 208 vote came mostly along party lines. No Democrats voted in favor of the legislation, and 12 Republicans broke ranks to vote against it. Many in the minority blamed partisanship for their opposition to the latest version of the bill.
Because it takes the safety net away from America's poor families.
It's no secret that the Republican Tea Party has a national agenda that's playing out right here in this chamber today. You are attempting to defund food stamps, yes you are, and place poor people, which includes children and the elderly and veterans, in a position that none of you would want to be in.
Mr. Speaker, I object to this bill because this bill is not just going to create tension among us, but the people of this country who depend on us.
Some people on that side have been trying to make this a partisan bill for 4 months, and they finally succeeded. And I don't know. I told my caucus that something I never thought would happen. You have now managed to make me a partisan, and that's a darn hard thing to do, but you accomplished it. And this is a bad bill. It should be defeated. We should go back and do a bipartisan bill like we worked in the first place.
Despite strident opposition, supporters said the only way a farm bill would move forward would be without provisions for programs aimed at helping poorer Americans, primarily the Supplemental Nutrition Assistance Program, or SNAP. The nonpartisan Congressional Budget Office reports that participation and spending on SNAP both soared to record levels in 2011. According to the CBO, nearly 45 million Americans, 1 out of every 7 U.S. residents, received SNAP benefits, formerly known as food stamps, in an average month. The result was an unprecedented annual cost of $78 billion.
Sometimes you have to have reform. Sometimes you have to do things differently. But at least the Ag Committee chose to make the reforms across our jurisdiction.
Those of us who came to town to cut spending, reduce the deficit, reduce the size of government, and make reforms have a real opportunity to walk the walk. This Farm Bill does all of those things.
We're down to this is our choice. For this bill, which can provide 5 years of predictability for agriculture, and an uncertain bill that might come before us on nutrition, which I think ends up without what I want, which is reform of SNAP.
The bill before us today repeals the outdated farm programs that we don't need and we can't afford. Direct payments, counter-cyclical payments, the average crop revenue election for the acre program, the supplemental revenue assistance program or SHORE program, all repealed in this bill.
Just hours before Thursday's expected floor vote, the full text of the bill was released. It was unclear at that time whether GOP leaders had the votes needed to pass the new measure containing only farm programs, and House Democrats reacted angrily to the last-minute move by the GOP.
Now you bring us another bill with no nutrition title at all. We cannot stand by and be silent when Republicans take these actions that offend what we are as Americans.
I am not proud of what you're seeing here today. The disrespect shown to this hallowed ground by hatching this abomination in the middle of the night and forcing it here because of extremist elements is the reason that the American people think higher of North Korea than they do of this body.
My party is here trying to make sure that we get a second shot at passing the Farm Bill, and that's what we intend to do.
Mr. Speaker, let me just say to the gentleman that the reason why we did not support the Farm Bill was because the Farm Bill that the Republicans put on the floor would throw 2 million of our fellow citizens off of the food stamp program.
Thursday's vote gave House Majority Leader Eric Cantor a victory in the wake of a stunning defeat in June when 62 Republicans voted against the original $100 billion per year version of the Farm Bill, largely because it only cut SNAP spending by 3%. Many GOP lawmakers said that wasn't enough since the program's cost has doubled in the last 5 years. The SNAP program doesn't need new legislation to continue, but Congress would have to pass a bill to enact any changes. The newly passed measure eliminates direct payments to more wealthy farmers and removes subsidies for people who no longer farm. Previous language developed at the committee level remains for commodity, crop insurance, and conservation programs. The measure approved by the House Thursday also repeals the so-called permanent farm authorizations of 1938 and 1949, making the 2013 Farm Bill permanent instead. The idea of a split bill was to pass the farm programs, which the CBO estimates would cost about $20 billion a year and contain about $1.3 billion a year in cuts to farm subsidies, and take up nutritional programs later. And House Majority Leader Eric Cantor said Republicans would act with dispatch to get that legislation to the floor.
Last week, a broad coalition of 532 agriculture, conservation, rural development, finance, forestry, energy, crop insurance groups expressed their opposition to splitting the Farm Bill.
American Farm Bureau Federation, National Farmers Union, American Soybean Association, National Association of Wheat Growers,
farm groups and a litany of others opposed the House's latest version of the Farm Bill, and some organizations threatened to use the vote against GOP members in future campaigns. Crude oil prices touched a 16-month high late this week as the world's most heavily traded commodity exceeded $107 a barrel briefly on Thursday. The rally was powered by geopolitical uncertainty in Egypt, declining U.S. inventories, and a weaker dollar. Other factors also are supporting crude oil prices, albeit to a lesser degree. Demand for gasoline typically peaks in the summer driving months, and in a development that could prompt increased debate on a controversial proposal known as the Keystone XL pipeline, a train carrying nearly 1 million gallons of crude oil derailed in Canada. Emergency crews in Canada spent the week extinguishing fires and searching for survivors after a train loaded with crude oil derailed about 150 miles east of Montreal. The train was parked near Lac Mégantic, Quebec, when it started to roll downhill. The runaway then barreled 7 miles into town, derailed, and burst into flames. All but one of the train's 73 cars were carrying oil, and at least 5 exploded. The train was operated by the Montreal Main and Atlantic Railway, and the investigation is focused on the train's engineer. The company's CEO said there are questions about whether the engineer set and applied the brakes properly before departing the parked train. CEO Edward Burkhart stated this week the engineer initially said he applied 11 handbrakes, a claim that is disputed by investigators. Burkhart said the engineer has been suspended without pay during the inquiry into the mishap. The derailment is Canada's worst railway disaster since 1864, when a train plunged into a Quebec river, killing 99 people. The crash has raised questions about the increasing use of railroads to transport crude in North America. The train was carrying nearly 1 million gallons of oil from North Dakota's Bakken Formation to a refinery in New Brunswick on Canada's eastern coast. Due to limited pipeline capacity in the Bakken region and near the oil sands in Canada, producers are increasingly using railroads to transport crude. The Canadian Railway Association recently estimated that as many as 140,000 carloads of oil will move on Canada's tracks this year. That's up nearly 29,000% from the 500 carloads shipped in 2009. Saturday's derailment prompted Canada's fourth investigation this year of an accident involving freight trains carrying crude oil.
Next, the Market-to-Market Report.
The Agriculture Department released its latest estimates on supply and demand Thursday. The numbers failed to move the markets very much and were viewed by many analysts as bearish for both corn and soybeans. That proved to be a preview of coming attractions, however, because prices for both commodities plunged Friday on a long-range weather forecast calling for a dramatic increase in rain in the western Corn Belt. Despite those developments, however, grain futures contracts still managed to post weekly gains. For the week, September wheat gained 21 cents, while the September corn contract moved 20 cents higher. Old crop soybean prices declined 43 cents Friday, but gains earlier in the week softened the blow as the August contract settled with a weekly loss of 3 cents. Nearby meal prices, however, rallied more than $14 per ton. In the softs, cotton traded sideways as the December contract settled with a weekly loss of a nickel per hundredweight. In the dairy market, August Class 3 milk gained 15 cents, while the September contract moved 4 cents higher. Over in livestock, the August cattle contract lost 10 cents, nearby feeders were off more than $1.50, and the August lean hog contract posted a weekly loss of $2.85. In the financials, the euro gained 230 basis points against the dollar. Crude oil soared to a contract high en route to a weekly gain of $2.73 per barrel. COMEX gold gained nearly $65 per ounce, and the Goldman Sachs Commodity Index gained 14 points to settle at 644.95. Here now to lend us her insight on these and other trends is one of our regular market analysts, Naomi Blohm. Naomi, welcome back.
Hi, Mike.
We've got a lot of news this week. Let's start off as we look at the equity markets. We've seen a continued rally on Wall Street. We saw the Dow and the S&P 500 touch historic highs, and NASDAQ coming at an all-time high. What is the driving force behind the move in Wall Street?
Yeah, big move this week, and it was because the Fed minutes were released from the report earlier, and investors found solace in the fact that the Fed is going to hang in there with the QE program until the economy really is better. So there was some more verbiage specifically as far as what better is and when better will be, but yet it's nothing that's going to be anytime soon. So the stock market just continued to rally, and the money is staying in the markets for now.
So we've shaken off the jitters from Bernanke's earlier comments about people feared pulling QE sooner than expected.
Right, and adding on top of that, the International Monetary Fund this week came out and actually forecasted growth yet for 2013 globally to stay at 3%, and they looked out for 2014, and they've got growth just under 4% growth. So it's not the dramatic big movements that people were maybe hoping for, but it still is growth. So that's really supportive for commodities overall.
And now as we look a little bit more commodity specific, is China predicted to continue growing quickly? I know there's been some concern with their banking sector. Is that predicted to continue for a while?
The growth is there, yet it's kind of harnessing back to a 7% growth, and they had always said that they needed 8% growth to really keep things on track and on target for where it needed to go long term. So they're pulling it back to the 7% area, but it still is plugging along.
Okay, and that didn't seem to spook many people. We did see increased Chinese purchases of new crop corn and beans this last week. And wheat.
Yes.
And yet that didn't seem to have much effect today in the markets. Talk to me about the wheat market. We saw a pretty big move today.
Yeah, so the wheat market over the past couple of weeks has actually pushed maybe 30 cents higher overall, and for the week we had some gains. Today was a quieter day. We're still dealing with the USDA report, which was out yesterday, and the report itself for wheat, they put the all wheat production number down just a little bit from the June number, and then they actually pulled back the ending stocks. They made them tighter for the U.S. and globally. So it's giving wheat some support, yet overall we still have this global supply that's out there. But China is definitely buying up wheat, and they're buying up the corn and the beans. And so what I think we'll see for the wheat market is the bottom forming. And we'll probably see prices maybe be able to push 20 to 40 cents higher at that time, though. Likely a selling opportunity for the Kansas wheat, the Minneapolis wheat, the Chicago crop too. So make sure that you're selling the rallies when they come.
And you see this 20 to 40 cent move coming after harvest, thinking in the next...
I would say really probably over the next 2 to 3 weeks, just more of a sideways, slow grind higher. The markets overall, I'm not quite ready to give up on them yet. So I think we'll see a little bit, one more little push higher.
All right, and sell the rallies. Be prepared. Sell the rallies. Now let's take a look at the corn market. Corn did have a down day today. As we mentioned earlier, there were some changes in the weather forecast that caused traders to get a little hesitant, especially heading into the weekend. Talk to me about where you see corn headed, and let's talk new crop December contract. What are your thoughts?
December corn right now has some real good support at the $5 area, and that likely will hold for now. We still, of course, have the question of are the acres there or are they not there, and that we'll find out in the coming months. Now, if you look at a longer-term chart on corn, the December futures chart, a weekly chart, there's a long-term uptrend that points to 450 as support, not only from an uptrend standpoint, but that's also a horizontal support level from going back to 2009. So if by chance December futures slip below $5 on this projected potential better weather pattern, 450 is going to hold it. I am not in the $3 fan club at all right now.
Okay.
So, and I think that for end users, that will be an opportunity to book some longer term needs. I mean, China came in today and bought 900,000 metric tons of corn, and earlier this week they bought corn too. So clearly there is value at this price point. And if the USDA comes out later to say that maybe there's 3 million acres of corn that were not planted, that takes a 500 million bushel of crop off that ending stock number. So right now the USDA pegged it at 1.95, and quite frankly, it could really be 1.45, which is $6 corn. So looking forward, 450, I think the low, $6 the maximum high. If we get higher, sell it.
And for the end users, be hesitant or be aware as we get down to that 450 level. Take advantage.
Yes.
If that acreage should change,
absolutely.
harvest should change.
Absolutely. Yeah, a lot of scenarios unfolding and a lot of things to be prepared for.
And now we've also, as I talk to producers out there, a lot of farmers, turns out, still have corn in the bin. This last week, we've seen some selling. Is now the time to unload any corn you've had left in the bin?
Anytime over the next 2 to 3 weeks, be making some sales on the corn. The July contract went off the board today just over $7, and so the big question is, will the September contract move higher or not? And if it doesn't, the cash market will stay firm, the basis will count on it, it'll make up for it, but we still don't have a reason to see the corn market just rally too much higher. The market likes the $7 cash area, and so anytime it's up on the higher end of things, do be making the sale because there is potentially a larger crop coming down the road no matter how you slice it.
Certainly, and even if it does come a little bit later this year, it will be coming nonetheless.
Yes.
Now, what are we hearing from South America as far as imports go? Is that picking up at all, importing South American corn or Canadian corn?
There still is market chatter about it, yet I haven't heard anything concrete about it. I think it's more of a verbal threat to try to keep people on their toes, but I haven't heard too much.
No big movements that you're aware of. Now let's take a look at soybeans. Again, same as corn, a down day today. Talk about the supply and demand estimates. How did that impact the market versus this weather scare today?
Great question. With the old crop, they continue to stick with that 125 number, not budging, but they did actually increase the ending stocks for the new crop, and that makes sense based on the crop conditions so far, really looking good out there. And what we'll probably see is the November futures price continue to waver between $12.25 support and maybe $13 resistance. And in 3 days this week, it went from $12.25 up to $13. And then today, of course, it set back. And so I think over the next couple weeks, as we know more about weather, it'll just chop around in those trading ranges. We won't fall apart unless the weather is absolutely perfect over the next 2 weeks to the month as the beans get into their growing season. But one thing I read today that was fresh news is that down in the south, in Mississippi, Alabama, Louisiana, and 30 counties down there, the soybean rust is becoming apparent. And so a little early yet, but something to just be aware of.
Certainly. And now as producers are looking, we're in this trading range next 2 to 3 weeks. What's your advice for folks marketing-wise? Get through this range and kind of see where weather goes, or would this be a good time to maybe make some sales and begin to hedge if they have extra hedge?
It's a really good question, and I would say that anytime that we get to the higher end of the range to be starting the cash sales now. A lot of people have not been aggressive with cash sales yet, rightfully so, wanting to make sure that the drought was over, depending on where you lived, and wanting to see how the crop is faring. Well, now we have pretty good reason to think that you'll have something out there. So do be making cash sales on the rallies. We'll probably start to look at doing some different hedge ideas in the coming weeks and on the rallies as well. So start thinking that way.
As the weather starts to play more of a factor. Now, as far as the market's concerned, is there much fear that come harvest time we'll find considerably more soybean acres than the USDA had estimated because of the late planting? Or is the market pretty much happy with what we've got estimated so far?
It's a mixed question because there's a lot of potentially double crop beans that haven't been in yet because the wheat harvest is late. And so that is a real unknown factor that we maybe won't know till harvest. And so that's something to keep an eye on. And even as of last week's crop progress report, 4 million acres were not even emerged yet out of the ground. So it's hard to answer at this stage.
Okay, so the farmers who maybe gave up on corn-planted beans, that added acreage could be replaced by wheat farmers who are not able to get into the field and plant soybeans. Well, now let's take a look at the dairy market. We don't get a chance to talk it very often on the show. I'd really like you to give us your perspective. What are your thoughts for producers as we look through the rest of the summer? How is demand shaping up for dairy products?
Demand for dairy is red hot. The U.S. domestic demand is stagnant. I think when people go to the grocery store, they know they're going to get the same milk, butter, cheese every week. But our export market is on fire. The powder market, we have record exports to China, Mexico, Algeria, Pakistan even. In fact, China, over the March-April time period, their powder imports are up 233%. And we actually have record cheese exports going on right now, too. And that's because the New Zealand drought, they're still getting over it. So the U.S. is the market where it's at. And we have huge production right now, too. So it's really good that the export market is as strong as it is because in the month of May, record production ever for milk, 17.7 billion pounds. So it's really good that we have a good, strong export market. And we're feeling that milk prices overall for the next 2 months, depending on the month you're looking at, will easily stay. No, it won't go lower than 17. Probably 18.50 might be the max, and just kind of chop and go sideways in that range.
Kind of the same range we've been in almost all year.
Yep, and you know what? It's okay. It's above people's break even, and that's all right.
And perhaps they'll have the opportunity to buy some corn, source some corn here at a little lower prices in a few weeks.
That'll be good.
Well, now let's take a look at the livestock market, heading from dairy into live cattle. We've talked about it on the show. The past few weeks, we've seen a nice rise in live cattle futures. Hasn't always been matched by cash cattle trade. What are your thoughts? How are things starting to shake out?
Yeah, we had a quiet week for cattle this week on the live cattle market. The funds defended the long position, even though the box beef values were setting back lower. So it's more of a tug of war. Of course, fundamentals are supportive long-term because of production declines, yet the consumer is always the sketchy one as far as will the U.S. consumer keep buying. Our export market picked up a little bit, and actually a third of our exports in May went to Japan, and Japan is really our strongest market right now. And even China, even though they don't directly import from the United States, that sneaks its way through Hong Kong, but they have been importing 10 times more than normal. So there is major demand from China that will be met from Australia potentially, but it's a strong market, and we'll probably see firm prices. We're not looking for rallies, not looking for it to sell off, but October live cattle, 126 is support, and then it's 125, and then it's 124. It's just these nice little baby steps that will keep us sideways and firm for a while.
Okay. Now, as we look at feeder cattle, with that demand built into the live cattle market, what are your thoughts on feeder cattle? Pretty bullish situation as we look forward?
It's a friendly situation because there's such a nice picture in the live cattle market, and now they've got better pasture conditions. They've got better chances of sourcing feed in the coming weeks and months. So it's keeping that market supported overall. And likely we'll see a little bit of a setback on the futures price because that market had been overbought, but there's solid support in the August contract at 150 and then at 148.5. So like live cattle, just a nice, solid, firm, sideways price action for the next few weeks and months.
And you mentioned how funds were a player in the live cattle market. Are they also a bigger player in the feeder cattle market? Are they in the livestock in general?
In past years, they hadn't been in livestock so much, but right now, because of the fundamentals being so friendly for cattle, they have been attracted to go there. So I don't think that they're in the feeder cattle quite as much, but the live cattle market, they're definitely making their notice there.
Does that, as we look forward, does that create any uncertainty in the market pricing? As we saw last summer, when funds get into the market, we can see big price swings upwards and downwards. Is that an additional layer of risk? Are they that big of players in the market, do you think?
They can be. In this instant in the cattle market, they aren't, the huge player, but if they decide to go away, absolutely, it'll affect our prices. But yet they're not quite as involved as maybe like they would be crude oil or the corn market, that type of a thing, but they're making their presence known.
Okay. Well, now let's take a look at the hog market. The hog market was up, all-time highs or close to it here the past few weeks, taking a little bit of pressure off this week. Where do you see it continuing from here?
A little bit more of a sideways to lower movement, and the wholesale prices are down, cutout values are down, exports have not been the best lately. Production for third and fourth quarter are expected to increase. The PED virus might be something that factors in longer term, but we're not sure how it's going to factor in. And so because right now we just don't have any immediate gratification news to take the market higher, we'll probably continue to see a little bit of a setback. Like the October contract right now is near the 85 area, and it could maybe set back, I think, at most to 82. And then we have to keep an eye on the belly market, and then after the belly demand is kind of done from the summer bacon demand, then the ham market is what we have to watch. And then if that ham market can stay strong, then we'll see the hogs easily maintaining the $80 levels probably for the next 2 or 3 months.
Okay, throughout the remainder of the summer, for producers looking for a chance to sell, keep an eye on that 85 range, maybe.
That's resistance for the short term. It's good support area kind of for now, and any kind of rally we may get there in the coming weeks could be a nice hedge for the shorter term, just because of this expected increase in production down the road. But at the same time, demand overall isn't diminished. It's a little slower right now, but it'll keep the market supported.
All right. Well, thank you so much, Naomi.
You bet.
That wraps up this edition of Market to Market. But if you'd like more information from Naomi on where these markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us again next week when we'll examine the outlook for cattle prices. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.